Good afternoon, everybody. This is Chris Robinson, Robinson Ag Marketing, with today's post-close grain and livestock comments for Wednesday, February 18th. We made it through hump day. These corn up a penny, March corn up 3/4. Remember, you need to get away from those March options. They're expiring Friday. I don't care if you've got puts or calls. Make sure if you've got some value in them, you get them out and at least get yourself into May, preferably a little bit longer. March beans down a half cent, 11.33. But we did get another wide trading range, right? From basically 28 to 44, a 15-cent range. And we may see this overnight. You see the Asians and the Europeans, they come in and buy it. I think they're chasing the money flow. I'm still waiting for someone to explain to me why the funds decided to buy 126,000 contracts of soybeans last week, given all the negative fundamentals we know about beans. That to me is very impressive, and it's going to be one of those things we're going to watch unfold. I'm not so concerned about the why. I want to make sure that we use it to our advantage. What does that mean? Well, we did get a high print last night of 11.24 in new crop beans. We settled down a penny at 11.16 and a half. However, the one thing you were able to do if you were interested was get some $11 puts for less than a dime for the next month. That is one way to capture the rally. It wasn't that long ago we were down at 10.50, 10.55 in November beans. So to get a good rally, I know nobody wants to call top. I certainly don't want to call top, but to go from 10.55 to 11.24, if you can get a chunk of that and have an $11 floor for less than a dime, that's not bad. And so that's what we've been looking at there. There are other strategies you can do as well, but that's just one that we've been looking at. And we have not gotten a lot of opportunity to do anything in the corn because corn, honestly, has been in a dismal trading range for literally going back to July of last year. So months and months of being stuck in this garbage trading range, 470 on the upside, 440 on the low side. It's 30 cents. There's nothing to do. I've had guys that have were working with me for 10, 12, 13 years. And honestly, there's nothing to do because there's uh, not a whole lot of meat on the bone. I totally get it. So what we have for those, anybody who wants them, I just call them their disaster puts. What would that be? Well, disaster put would be if for some reason we pull another 2010, where if you go back there, we drifted um, with some ebbs and flows, but we really drifted lower all year, all the way into June. And then finally in June, on the last final 8 acres report, that's when we turned around. We got a little bit of weather and we recovered. But I don't want to be sitting here with unpriced beans and we watch slowly go from 460 to 450 to 440, and then we're making new contract lows, and guys are like, well, I coulda, woulda, shoulda. I haven't spent more than 4 cents on a corn put all year. Maybe the longest term ones I think I spent 7 or 8 cents, and that was the most ever. And I don't recommend spending too much, but you can get yourself at least a disaster put. And again, why would you do that? Well, because we don't know. I don't know what's going to happen. We've got a 2.7 billion bushel carryout. Yes, the exports have been great. We've been chewing through that. But if the 2026 growing season is, Garden of Eden like, um, we're going to be in the same situation where we're producing more of what the world wants less of. So we're going to have to watch the safrinha crop coming out of Brazil, South America. What's that going to look like? We're going to have to continue to watch if the corn exports continue to be excellent, which thankfully they have. And I can't imagine where we'd be if corn exports weren't as amazing as they've been. Um, and then the big story we're going to talk about in the title of today's letter that I wrote, are we really going to have an acres of work? The ag forum's coming out, and the estimation is that there'll be 3.5 million less acres of corn planted and close to 4 million more bean acres planted. Well, that's because people are looking at the prices going, okay, 460 corn versus 1120 beans. Why wouldn't you plant something that's at least profitable? If corn's gonna not be even break even, why would you do it? I mean, you're basically just planting your crop and hoping that we get a drought, hoping that we get, continued good exports. So The fact remains is that right now we've got a pretty good opportunity here in beans. My concern is that if everybody, if we have a 7 million acre swing, right, 3.5 million less corn, and we have 4 million more bean acres. Well, what happens if we end up with a huge Garden of Eden crop? We don't have a weather issue this year, and all of a sudden we watch 11-10 beans turn into 10-10 beans or turn into something crazy like that. So um, the good news is you don't have to spend a fortune to protect $11 beans right now. So, and also too, I don't think there's anything wrong with making cash sales up here to get something sold just to get you started. I'd rather sell it into an 80 cent rally than sell it to an 80 cent break. Call me crazy. In the wheat, again, kind of at least a better recovery. You're up 12 cents in Kansas City March, up about 9 cents in Chicago March. We are dancing around, multi-month highs here, but we're moving in 20 cent daily ranges, right? If you look at March wheat Chicago, we really, we hit that good level there at 533, excuse me, 553, and then 2 days later we were trading at 533. Same thing happened with Kansas City. We had a really good rally. We gave back a chunk of it very quickly, and that's because honestly, there's just more volatility in wheat trades, like wheat. I mean, I'm looking at KC with traded 555, and then 2 days later we were down nearly at um, 534. So 20 cent break. So get used to that. Big picture, 551 is a lot better than 477 if you look at March Kansas City wheat. So it's certainly a lot better. We're 50 cents off of that risk area down there at $5. So take advantage of it. Um, if you're growing wheat next year, you can go out and look at Chicago. Soft red winter is trading back up to 560 again. Again, is it what we need? No, but it's a heck of a lot better than being down at 525. And we really don't start getting healthy in July. Chicago wheat until we start getting north of 590. That's 35 cents to go. So there may be some opportunities heading in there if we get some sort of weather issue as well. In the protein complex today, we were very, very, very quiet. April fats finished down 27 cents at 242.50. March feeder finished down 40 cents at 370 and a half. April fats, a little bit of recovery after losing $8 on this last correction from the highs. It was a very technical pullback. It was a pretty much um, picture perfect 38% retracement of the last sell off. We'd gone from 81.10 to almost the buck. And this 92 half level is right there at 38% retracement. We literally got it halfway back in the April. Halfway back in April, hogs would have been 90.5. We traded to a low of 91.125. So very, very close to that 50% pullback. You see some people covering some hedges there. Hopefully the trend continues and we continue to move higher. Managed money continues to be long the protein complex. We do have a cattle on feed on Friday. If you've done nothing, you've been very, very lucky because we've had a $35 rally up the lows in fats. We've had a plus $70 rally up the lows in feeders. That's revenue I think that most people would want to try and defend. And so set a hedge. What else? A little bit of action in crude oil trading here between 65 and 66. 66 is big resistance. We were down at 62 just last week. What's driving that? Just headlines, just guys trying to get in front of whatever this latest mess is between the United States and Iran as they try and figure out these new nuclear talks. Iran's been kind of spouting off in the headlines, and that gives reasons for people to try and get long. It's rolled over into diesel. Diesel is basically sitting in the middle of its last spike. Remember, we went all the way down to 204, which was about a 7-month low. And then in 10 days, we spiked to 277, which was a 2-year high. So this pullback here to this, we're kind of sitting like halfway back here at diesel. If you use a lot of diesel, certainly that when we dipped down to 204, I made some comments in my letter for anybody that, if you use a lot of diesel, look at trying to take advantage of that 7-month low. I did not know that was a low. I'm not saying woulda, coulda, shoulda. I'm not saying I've got some magic 8 ball here that tells you where the lows are in. Um, so if we get back down there again to that 204 level, $2 level, I'll be saying the same thing. We're at the bottom of the range. Maybe do some hedging or some pre-buying. We'll see how this all turns out with crude oil moving forward. It's kind of all intertwined. But right now, to wrap it up, I mean, I think the fact that we are at 11.15, 11.16 new crop beans, that's the one opportunity I don't want to miss for 2026 farmers and producers. All right, guys, this is Chris. Have a great rest of the night. 312 638 8868. Give me a call. Let's touch base.